Let's bring in Gabriela Santos. She is Global Market Strategist at JP Morgan Asset Management. Always good to see you, Gabriela. Let me ask you about this little, I'll call it sort of this mini rally we've been seeing the past few days on Wall Street. Do you think that this is the beginning of a road to recovery for investors? And do you think that this rally really has some legs?
Thank you so much for having me again. And I think it's really a rally that began back in March 23rd and has really, for the S&P 500, driven us about 30% off of those lows. I think it's been just this period we've been in where we've been hearing a lot more positive news. We've had, of course, a lot of action by the Fed. We had a lot of action out of Congress. And then we've had positive news on the health front as well. And in terms of your question, how long this rally can last, look, we think we're entering in a new phase now about the reopening of the US economy, the global economy, and we really do still think it's going to be complicated. So we might be in a new phase where we start to actually understand just how slow and gradual and difficult the reopening process is. So we are still cautious, and we still think it's really important for investors to think about the quality of companies they own, because this is not just a difficult month or two for these companies, for the economy. It's going to be a difficult year ahead.
Gabriela, I'm surprised by some of the valuations on individual stocks, specifically big cap tech, surprised about the valuation of the S&P 500. Taking a step back, based on your recovery plan for the economy, do you think the market's just overvalued here?
So I think it's tricky. When we look at next 12 months price to earnings ratios, they're at about 19.8 times. So that's really the highest we've had since the early 2000s. But that's a little bit murky because we have still very little visibility on the earnings outlook. So for us, we prefer to look at price divided by 2021 earnings, which is expected to be that first year of recovery. And there the market is looking a little less overvalued. It's about 17 times, but it's still significantly above average. So it's a market, we think, that is really gone a little bit ahead of itself here in terms of just how difficult, not just 2020 is going to be, but even the early part of 2021. And it is one of the reasons that we are still cautious here. We do still think there's a lot of differentiation that's going to continue to happen beneath the surface. We are actually still optimistic about technology, healthcare, consumer staples, but also still a scenario where we don't want to be adding too much risk. We want to make sure we still have that quality fixed income part, given that we do expect some volatility ahead.
Gabriela, when you look at global markets, where does the U.S. market fall in there in terms of recovery? And should we as U.S. investors be looking to other parts of the world to say, oh, okay, that's where they are now. We'll probably be there in 4 to 6 weeks.
I think that's such an important question because, I mean, the U.S. market is very defensive. In moments of risk aversion, it does hang in there pretty well. But if we think about recovery and how quickly other regions can recover, I do think U.S. investors really need to think about North Asia. And that's really China, Korea, Taiwan, which are markets that have dealt with the healthcare issue a bit better. And not just because they had the virus first, but also because they've put plans in place for this reopening phase that gives us more confidence that they can reopen in a more risk-adjusted manner. So thinking about testing, contact tracing technology, isolation procedures, and just a general sense of collectivism that they have in their society, which is really useful in this moment when we still have to deal with the health issue first. So I do think there's a lot that should be said about emerging Asia equities, especially here for the next 12 months, as well as for the longer term story, where that's really where the growth of the middle class is going to take place.
You mentioned a portion of an investor portfolio should be allocated in fixed income. What percentage? We just talked to a strategist at Wells Fargo suggesting that defaults for many corporations are on the rise, and we could see pretty dramatic rises over the next 2 to 3 months.
That's right. And that's really behind this idea that this is not just a difficult month or two that we've gone through, but it's going to be still a very challenging year where life doesn't really go back to normal until we get a vaccine that's widely distributed a year from now. And that's going to continue to impact certain sectors. It's especially going to continue to impact sectors that are in the services sector that are still going to need to operate at below normal capacity because of the virus. So we're thinking about hotels, airlines, restaurants, bars, live entertainment. That's still going to be very challenged for the next year. And that's where we can expect to see defaults increase. And so when we think about the fixed income piece, we're thinking about quality fixed income. So not venturing out quite as far into things like high yield, for example, as we would in other moments. And also thinking about the kinds of sectors, the kind of companies we have, and are they overly exposed to this still difficult environment. So it's really quality first, I think, and security selection. That's still really, really important.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.